All right, everybody. It is Wednesday. We are coming to you live from Investing Education Academy. Just waiting for one thing. All right, we are good. So, wanted to first say thank you to everybody for definitely sticking out with us. Now we are 1 year past our 1 year anniversary. 1 month past our 1 year anniversary. So this is actually pretty big for us because at this point we're becoming a slightly more mature company. It's only because of you all support. We have definitely seen some people become millionaires, which is also great. We've had people, more than one, more than two people become millionaires. And that's really cool that we can say we've been part of that. In addition to it, some of you all who have sent in your returns, we have people in the community seeing 10% rates of return, 20%, 30%, 40%, yep, still going, 50%, 60%, up to 70% that we are aware of percent rates of return. Maybe it's higher. That's what we've heard, up to 70+% rate of return. And that's pretty awesome because the average savings account in the United States at this point is paying between 0.05 and 0.06% on your money annually. Again, we've seen people have rates of return 10 to 70% rate of return. That means some people are doubling their money each year. I think I can literally put a post up probably in a group. I will do it. I'll do it. This week alone, I know one member's made about $8,200 some dollars this week. And we're talking about we're at Wednesday. So my challenge to everybody is, what has your money done since Monday? How much have you made since Monday? This is not a better than worse than situation. We're really trying to wake some people up. If your money is sitting in a savings account, unless you have like tens of millions of dollars in there, you're pretty much throwing away your money. Honestly, even then you're throwing away your money. But we're trying to be positive. So, in this space, please take all this information, use it to make a change in your life, use it to improve what you're doing with your money, and turning your dollars into better employees. Now, Leon's going to tell you what our topic for today is. I'm going to tell you, if you're interested in becoming an IEA member, you can go to IEAnow.com. The web address is in the comments. If you're listening to the podcast, go to www.IEAnow.com and you can sign up. If you're interested in becoming an IEA Portfolio Panther, we are about to change up that platform just slightly, and more to come. Just know that platform is about to change. We have maybe 3 or 4 more slots left if you're interested in joining. It's $5,000 a year. After we get the next 4 members, in which case we got 4 in the last 2 months. If we get 4 more members, we will be closing the group. When it opens up again, it will be $10,000 per year if you want to invest with us. So totally your choice. We keep it very light for IA members, but that is the fact that you have to deal with right now. It's $5,000 a year at our highest membership. When we get the next probably 4 or so members, we're going to close down that group. When it opens back up, it will be $10,000 per year. Now, on the cryptocurrency side, if you want to become an IA crypto bull, that platform is also growing. So IA is growing in general, but these platforms are growing. The conversation happening in the IA Crypto Bulls ecosystem is something you just want to be a part of. It's the best way I can describe it. We're talking about in the month of July, and Leon, if I say anything incorrect, some of the coins when aggregated that we were discussing in the month of July had over a 300% rate of return.
280. Just saying. You said. I mean, 280. Yeah.
So a few of the coins when aggregated that we discussed in the month of July alone had a return of 280% for that month. If again, you can maybe keep your money in a savings account. You feel good. You can see it. You feel comfortable because you know what savings accounts are. You are losing. And I know you're like, why does this guy Brent always say that? And I use my name in case I listen to the podcast, they don't blame you. It's Brent talking. I'm telling you, you're losing because no one else is probably telling you this. I know the people at the bank aren't telling you. Every time you come in there, like, how you doing? How can we help you today? You feel great. But when you leave, the bank is the only person making money. Let me change that. The bank is the only entity making money for its shareholders and for the executives in the bank. The tellers aren't getting rich. The people who are, driving the money to and from the bank are not getting rich. The people putting their money into the bank aren't making a tremendous amount of money with the bank. It's the investors and the C-suite and the executives. So I just need to take some time to talk about that because it's real. And Leon is going to tell you the topic today and why we chose it. And again, if you want to become an IAA member or just join a group, any group, there's groups out there that are doing some great stuff. We just want you to immerse yourself in that environment. Make talking about investing a regular thing because, Leon and I are fans of some groups out there and there's nothing wrong with it, but do something different. So
yeah, if you don't join us, search on Facebook, on the internet for investment groups, crypto groups. We think IEA is the best, of course, but there are plenty of other ones out there. If you're just by yourself, definitely get with a group. If it's not us, find somebody else, but get with somebody so you can have these conversations. 2 points I want to make first, just to touch on 2 points Brent made. As far as returns, I just actually checked my return right before we came on. So through today, I'm up 57.6% for the year. So I'm approaching doubling my money. Hopefully by the end of the year, I'll be at 100%. But I'm up 57. I'm up effectively 60% on the year through August. And another point on the interest rate thing is that my only credit card is Capital One, and they sent me an email really trying to push their I can't remember if it's a savings or checking account. But they gave all this copy before how great it is, all the stuff you can do, all these perks it has. Of course, at the bottom, they had the rate that it was going to pay. The rate was 0.10% APR for the year. And it was just funny that it was almost in small, it was based in small prints and at the very bottom. Before that was all the fluff about all the perks and what I can do and this, that, and third. They didn't trump. They weren't out there, talking about the interest rate. It was a small little piece at the bottom. Again, the interest rate, Capital One, either checking or savings, they were trying to get me to join, was 0.10%. Now that is double the national average for a savings account, which is 0.05%. But again, it's just ridiculous. So just 2 points. One, I'm up 57% for the year, and two, interest rates are horrific at banks. All right, so the topic today is
real quick. Let me touch on that. When we tell you all these things, we're not saying we're up 57% because we're just telling you. People don't believe sometimes that it's possible. And one of the things I looked at on my account was, now if you have an E-Trade account, they have an amazing feature now. You can actually weight what your performance is against the certain indices. And so like it'll compare what your rate of return is compared to the S&P 500 or the Russell 1000 or whatever. And you can actually choose what you're weighting yourself against. One of my accounts is up 35% today, or year to date from January till today. 37.6%. It beat every indice that I checked. Now the S&P 500 was very close for a year to date return. And I think it was like 32 point some percent. And this is the thing, it doesn't really even matter that, Leon, you're crushing it. I'm beating it. But
real quick, I do want to say that 57% includes crypto. So I just want to make that point.
Are you including crypto?
That's crypto.
You including crypto?
Yes, crypto and stocks. I'm up about 60%. Now I will say it would have been higher, but early in the year I did a withdrawal from my crypto account for something I had to take care of. So, but yeah, I'm up. So together I'm up 57%. Yeah, yep, for the year.
Okay, if we're throwing crypto in, so I have 6 cryptocurrency accounts. So it's really hard for me to figure out. 6
separate crypto. Well, exchanges. So yeah. I have 3.
Yeah, well, in case you all are wondering why we have so many, cryptocurrency is a platform where they don't offer every crypto on every platform. And depending on how you buy and sell your crypto, there are advantages to some platforms over others. So, it's a mix.
And not every exchange sells every coin. So you have to have you typically have to have multiple exchanges to buy different coins.
Yep. And so that's why I have 6. And with that being said, if you add in crypto, I don't know what the rate would be, but it'd be definitely higher than
it would be. Yeah, it would definitely be. You'd probably up there 8, I don't know what your return, but 60, 70, 80, 90%, maybe over 100.
Yeah, it'd be pretty sick. But this is cool. Like, these conversations need to be regular. So Leon and I, for those that don't know, we started Investing Education Academy because these were our regular conversations. And we realized so many people weren't having conversations like these with their friends or with their inner circles. And we were like, all right, well, if we can maybe publicize these conversations, hopefully people will believe it because we're 2 regular guys, right? But then they'll take action and go do it, which we said, all right, let's create Investing Education Academy as an organization, a membership organization. So they have a platform, a support system where this is regular. This is normalized conversation. Because again, everybody who's watching this, and share it with a friend right now, if you keep your money in a savings account, you are losing. So it's no other way.
Literally, yeah, literally.
Anyway, Leon, you can.
Yeah. One other point. Before the crypto crash, I believe I was over 100% for the year. So when crypto dropped by 50%, that brought me down to about 60%, where I'm at now, about 60%. But before the crypto crash, so if crypto kind of comes back to where it was where it was back in May, I definitely see myself doubling my money this year. But anyway, just want to make that finer point. So today we're going to be talking about something that a lot of people have no idea exists and don't know what it is. What it's called, the topic is called closed-end funds. Most people know about ETFs, electronically traded funds. Those are typically like stocks. They're typically sector-based. You buy them like stock and you invest in software, databases, what have you, retail, what have you. The difference with closed-end funds. So closed-end funds are very interesting. They have many similarities with ETFs. They're typically compared to mutual funds, not really ETFs, because of the structure of them, and we'll kind of go over that. We're going to go over that right now. So Brent put up the slide, and the topic is, so we're saying, what are closed-end funds, and why do they pay such high dividends? So closed-end funds are known for paying ridiculously high dividends, and I'm talking upwards of like 20%. I've seen as high as 22%. So just kind of give the range. Closed-end funds on the low end will pay anywhere from 6 to 8%. And on the high end can pay upwards of the low 20%, 22% dividends per year. Huge, just huge, right? So they're called closed-end funds. So, you may ask, okay, what is a closed-end fund, right? So all closed-end fund is just a fund where so right now, a lot of people know about SPACs. And what SPACs do is they come to the market, they have an IPO, and then they trade on the exchange, but they have that pool of money. And that, I don't want to be confused the two, but just kind of get the concept. When a SPAC IPOs, they have that pool of money they have to spend within, I think, 2 years, or they have to give it back. But when they IPO, there's not really a company there; it's just a pool of money. Well, closed-end funds are similar, right? So they'll do an IPO, and then the money from the IPO goes into a fund, right? And then just kind of sits there until the money manager then decides what they're going to do with it. Now, what's different about closed-end funds versus ETFs or even stocks is that closed-end funds only sell a fixed number of shares, and then they raise a fixed amount of money, right? So typically most IPOs, a company can come out tomorrow and raise $100 million, right? And they may sell, I don't know, 30 million shares. And now I'm just throwing numbers out there. Say they raise $200 million. But what they can do is, let's say after 6 months, a year, even a few days after, they can then go on the market again and sell more shares, right? Or they can do what we covered last week, what are called buybacks. They can actually buy back shares if they want. So the share count could be, I didn't use the term manipulated, but the share count could be increased or decreased based on the either the ETF that runs it, or the company that runs the ETF, or the stock. Closed-end funds are different. Closed-end funds, when they sell, so let's example, say a closed-end fund sold 1 million shares at $10 each at the IPO, right? That's $10 million. That's it. They'll never sell another share, and they'll never buy back shares. So $10 million is the fixed amount of money that they're going to raise. And then the 10 million share, and then 1 million shares is going to be the fixed amount of shares that are out there in the market. It'll never change as long as that closed-end fund is in business. So that's one aspect that's different. Again, fixed amount of money, in this example, $10 million, and 1 million shares. That's it. It'll never increase, it'll never decrease. Now, what that does is, second bullet point is that it gives kind of a stability to the shareholder base, right? So you're not seeing a fluctuation of more shares being added, shares being bought back. It's just a consistent, in the example I use, a consistent 1 million shareholders, and that helps kind of keep the price relatively-ish stable. Kind of, I mean, I'm not really gonna say it's stable, but it doesn't allow for a lot of volatility around investors coming in and out of the stock. Now, there is a level of volatility that we'll cover in a minute, but next bullet point is that closed-end funds trade on exchanges, right? So they trade like stocks, they trade like ETFs. You can buy it, any time of the day. You can see it, tick up and down every second of the day. Unlike mutual funds, like Brent told us a couple lives ago, they only trade at the end of the day, whereas ETFs and stocks trade every minute of the day. Closed-end funds are the same thing. Now, next point is a major point. So they typically pay higher dividend yields compared to stocks and ETFs, and they do this by using leverage. Now, Brent and I have always said, if you look at companies, and if you see like a regular stock, let's say just say Microsoft, for example. If Microsoft was paying a 15% dividend, that would be kind of a red flag, because most companies, because remember, dividends are paid out of net income, out of the bottom line, of the profits. And if a company is paying 15% of its profits out to shareholders, that's a huge chunk of change that they're not putting back in the business, not paying employees and not just running the day-to-day of the business. It's kind of a red flag, because most companies can't afford to just send 15% out the door. So typically what you'll see is a lot of individual companies that do that, they're doing it via a loans, leverage that they're borrowing to pay these dividends, which is very dangerous, right? Because if they can't pay back those loans, they can't pay you that dividend, and the company could even default, right? So, and remember, in companies that are in the market, they can borrow as much as they want, right? There's no cap or any regulation around how much they can borrow. Difference with closed-end funds is that the amount they can borrow is regulated, right? So they can only borrow up to a certain amount of money, and there's a whole calculation behind it. But just know that the amount they can borrow is not unlimited like stocks, like individual stocks, and it is regulated by the SEC. So that gives some comfort into knowing that yes, they are using leverage money, but it's not just into infinity. There is some cap to it. Next point. Oh yeah, go ahead.
Yeah, one thing, when you're talking about closed-end funds, and also when we talked about SPACs are special purpose
acquisition company, corporations or companies. Yeah.
So if you're trying to Google it or look it up, they're special purpose acquisition companies. For those of you all who are just trying to get familiar with SPACs, and the ETFs that we're talking about. When you talk ETFs is part of what we're talking about. When you look at ETFs and closed-end funds, they do trade, like Leon said, similar like stocks. Really, they do trade like stocks, but ETFs have a much more passive management structure than a closed-end fund. I'm trying to think of the right words to use when I describe it. And that means that the fees are lower. So one of the things, we're not really looking at, but I think it, should be mentioned, is that ETFs are going to have much lower fees than closed-end funds. So.
Yeah, yep. And it's kind of a trade-off, right? Because ETFs don't pay anywhere near as high dividend yield that closed-end funds do.
And really,
is
if an ETF even pays a dividend.
Exactly right. If an ETF even pays a dividend. So like everything is where nothing is free, right? So if you have a closed-end fund that's paying 15%, their fee is going to be higher because it's risk reward. They want something for that higher return they're going to give you. So yeah, so look, that's a good point. So closed-end funds will have higher fees than ETFs, but that higher fee also comes with a much higher potential for return. And again, remember that range I said. Low end for closed-end funds is roughly 6 to 8% dividend yield, up to 20+% dividend yield. And so the second and last point is a big point too, right? In that the dividend that you paid from a closed-end fund is not double taxed, right? So when you get your dividend from like Microsoft, it's double taxed because it's taxed at the corporate end. They pay a tax on that, and then when you get it, you have to pay income tax on it, right? So it's double taxation. Typical corporate tax. Corporate dividends are always double taxed, called double taxation. Whereas with closed-end funds, that's not the case. Closing funds are similar to LLCs. They're like pass through. So they'll pass through that dividend to you, and then you just pay taxes on it one time. You pay the dividend tax on it. So that's another good aspect of it. When they pay really high dividends, and then those dividends are not double taxed. They're only taxed one time. And the last,
real quick, before you go to this last piece, I'm going to give everybody a little secret that nobody knows unless you're a licensed financial advisor around the end of this. So just stay, if you're watching Instagram, I'm going to tell you a little secret, an insider secret about funds that really most people don't know as it relates to NAV.
And then last point, yeah. So last point. So what's kind of cool about closing funds is so one of the things we all know in the stock market, right? We never know just by looking at price if a stock is ever cheap or expensive. And there are many ways you can do it. You can do it, via PE ratio. You can do sales to revenue, sales to stock. There are many ways you can judge a stock's value, but it's always relative and it's always subjective, right? If I look at PE, someone else may look at another indicator. With closing funds, most people look at what's called net asset value, and all net asset value is just the assets of the closing fund minus the liabilities gives you a value, right? So to give an example, let's say that the example I gave earlier, XYZ closing fund sells 1 million shares at $10 a piece, raises $10 million. What the fund will then do is the fund will then go out and it can invest in anything. It can invest in real estate, it can invest in stocks, it can invest in private equity, it can invest in sneakers, whatever it wants, right? It can invest in anything it wants. But what the net asset value really tracks is the value of what it's invested in, right? Minus its expenses. So example, say this closing fund goes out and buys, say it invests in stock, right? And let's say that stock goes up from, it takes a share price from $10 to $15, right? So now we're looking at 1 million shares worth $15, which is $15 million, right? So there's been basically a 50% increase in the price. Now the share price is now trading at $15 because that's giving the value of the stock that it owns. But let's say that so that means the net asset value is 15 million, which translates into $15 per share. But let's say for whatever reason the stock is actually trading at $13, right? At that point the stock is actually cheap relative to its net asset value or the assets that this fund owns. Versus let's say the stock was then trading at $18. If the net asset value is roughly $15, then the stock is expensive, right? So with closing funds, it's a really easy way to judge when a closing fund is expensive or cheap. Now there are many reasons when a closing fund is actually trading below its net asset value. There are many reasons why I can do that, right? Typically, most funds will trade somewhere around-ish their net asset value, but when you see a discount, it can either be a great opportunity or it can be a red flag. And then vice versa, if it's expensive, there are a lot of reasons behind that too. And we're going to go, so just real quick, just to give the announcement, we're going to be doing we're going to actually be opening up a closing fund group inside the IEA membership platform, where we're going to be researching closing funds and then presenting that to our members as potential buying opportunities. Because like I said, they can be really good income generators if research is done right. So last point again is just showing that with closing funds, you can really judge whether it's expensive or cheap relative to its net asset value. And then if you're ever looking for one or information on the net asset value, most platforms that where you can trade closing funds will actually give you the net asset value of that fund. And then you can judge for it. Hey, if it's should be trading at 15, it's trading at 13, it's cheap. If it's trading at 15, should be trading at 15, it's trading at 17, it's expensive. And I just want to give one example. So there's a member inside IEA, inside the membership platform, Brandon F. We have two Brandons. So Brandon F is who I'm referring to. He told me about a closing fund he's been in for about a year. And over the last year, it was up 15%, right? Now this closing fund pays a 9% dividend yield. So that means last year, all through last year, he made a total of 24%. Now that dividend yield alone, because remember, he made 15% just depreciation of the stock. But then with the yield, he made another 9%, which brought him 24% total. So think about that. That yield increased his profits by 60%. For him doing nothing, just straight owning the closing fund, he got his 15% from the appreciation of the stock, and then got the 9% on top of that, which increases gains, his stock appreciation gains by 60% for doing nothing. So that's the power. That can really that's really the power of closing funds. And like I said, 9% on some of these funds can actually be low. A lot of them are in the teens or in the 20s. But that's just a real world example of someone I know who traded, who owns a closed-end fund, and he got, he saw a huge benefit from the high dividend.
And for, the secret is when I was a broker, 2001, again, we were writing tickets. And one of the things that I learned very early after passing a Series 7, financial advisors who are licensed with, I think, a Series 6 or Series 7, only pay NAV for funds. You don't have any markup at all. And I thought that was amazing. I was like,
wait, explain it.
So how there's a markup, and the markup, how much it is based off how far away from NAV it is.
Oh yeah.
We only, at the time, we only paid NAV. There was no additional fee for financial advisors.
Oh, okay. Yeah.
So we would call into a fund company, give them our license number, and we would by default get it at NAV, which is a huge.
So if it was trading at above, the stock was trading above NAV, you all would get it at the discount.
Yeah.
Is that only that? But that's because you were licensed. You were
licensed broker.
Right. Okay.
And so
okay.
Again, it's one of those things like the system is rigged for people that know how to be in it. But what I will tell you is it also promoted most financial advisors to get mutual funds, in which case I wouldn't do that anymore. But it was a cool thing back then. I would get it now just to kind of leverage out my portfolio, but it wouldn't be as much of an exciting thing as it was back then.
But wait, so that discount y'all get, was that on mutual funds or closed-end funds?
It was on mutual funds, but if a closed-end fund had a markup, and also don't forget, some mutual funds can operate as closed-end funds, right? So in particular, it was capital as, what was it? Oh, you about to make me go back.
Don't get too wonky now.
I know it was, and this is my age. It was won by Oppenheimer. Oppenheimer had a high capital. Yep. It was their high capital yield closed-end fund. And you had to have $10,000 to get in, number one. When you got in at $10,000, they only took a certain number of investors. And when they closed out, once they hit that number of investors at that dollar amount that you had to come in at, that was it. The fund was closed, like nobody else could get in. But when we came in as advisors, which was a very popular fund back then, it was paying a 15% dividend. I remember thinking like 15%, and it was 15% for at least 3 years that I was working at this one particular firm. And it seemed like everybody that called in wanted that fund. So yeah, there's some amazing things happening inside those funds. Now I would consider it to be part of a portfolio where, maybe 2-3 years out, I would have felt like it went too slow. But, as you think about your portfolio and what you're investing in, these are the things, like, you should take this information today and just start doing research. And one of the people asked us, what platforms do we use to buy crypto? One of the platforms I use is Robinhood. I know another one is crypto.com. And then there's like 5 others that we use that are inside the IEA Crypto Bulls platform. So feel free to come, but those are 2 that we use. And there are a lot of others. And one of the platforms we have gives us free crypto. Like, is it once a month, Leon?
No, I think it's doing that. I mean, I think it rotates, seems like every other day, maybe at least once a week, but no, I think it's more than that. It's quicker than a month, I believe.
Well, at least twice a month or once a month.
Yeah.
It gives us like a few dollars of free crypto for taking these like little tests. And it's so many benefits. I mean, we're mining, we're doing all kinds of stuff in the platform. So, if you're really interested, and I saw Jay White check in, I'll definitely give a shout out to Jay. He recently became an IAA Portfolio Panther, and he is full in. Like, he is.
Jay, I love it. Jay's engaged. I love it.
Yeah, and Monteith, definitely want to give a shout out to you. Your comments and contributions have made the platform much more lively than what it was any other point in time. So your impact is felt, and I see your question. So hit me offline, and I can tell you some more. But if you're thinking about how can you change your relationship with money, how can you make your dollars better employees, we urge you just kind of look around IEA. We are going to start also putting more information in on the in some of our groups and also some of our topics. Leon and I will be taking some away, kind of cleaning house. We're a year old now, so it's time we start growing up. So there's going to be some changes to the platform, and the changes we have coming to the IEA Portfolio Panthers. I'm pretty sure the Panthers are going to love it, and those of you all who've been thinking about it, if you don't get in before we take it up to 10,000 a year, you might regret it. But that's for you to decide. Everybody, did we miss anything, Leon, before we go?
Nah, just to recap, if you're watching this, listening to this, just Google closed-end funds. They are income general. I mean, think about it, just real quick. So the friend of mine who had the closed-end fund that paid 9%. If that closing fund that he bought, the stock of it, if it went down 5% for the year, he's still netting 4% because he's getting a 9% dividend yield no matter what the stock does. So with these high yields these high dividend yields that these closing funds pay, I mean, of course, nobody wants a stock to drop 4%, but I'm just saying if it did, he would still come out on top. So definitely, do your research on closed-end funds, add it to your repertoire. Like I said, we're going to be creating a group inside the IEA membership platform where we're going to be researching closed-end funds and then presenting them to the IEA members, just to add more diversification to the suggestions we make to the group and to the members. So everyone watch out for that inside the membership platform.
Yeah. So everybody, thank you for being with us today.
And remember our talk about picks.
Oh yes. So you can find our picks in the Investing Education Academy Facebook group. That is where we're putting our picks after our lives now. Yeah. So look for them there. And Leon, I would kind of say at this point we might want to start putting our picks in the platform only. But we can talk about that.
Yeah, we can have a discussion. Yeah.
Yeah. So everybody, thank you for joining us today. Thank you for listening to the podcast. Podcast continues to get 700 plus unique downloads per month. So that's awesome. And you guys just sharing these views. Several of you all have bought memberships for your kids. That's awesome. And it's so many good things happening as a result of this. And that really makes me and Leon feel great because we didn't really start IEA as just a money play for us. We were doing well in the market. We wanted to educate those around us because this wealth gap is getting bigger. I mean, there are articles out there that the brokerage firms are producing, talking about how the wealth gap is getting bigger. It's not even Leon and I. This is like a lot of information coming out about it. So we're trying to do our part. And, hopefully, again, these conversations move some of you all to action, be it joining IEA or just doing some research on closed-end funds. Like, what are closed-end funds? Should they be part of my portfolio or my asset allocation model? I don't know. It's for you to decide when you figure out what your suitability is. And if we're talking about asset allocation models and suitability and your long-term investment goals, and you're thinking I don't even know what that is, you should probably join Investing Education Academy because these are things that we do talk about on a regular basis. So with that being said, everybody, please enjoy your day. We will see you all next Wednesday, and some new announcements are coming up. So definitely check back with us and share this time slot with your friends.